Okay, let's be real for a second. Have you ever seen that MACD crossover, jumped into a trade thinking, yes, this is the one, only to watch it just completely reverse and stop you out? It is one of the most frustrating feelings in trading, right? You feel like you're following the rules, but something's just not clicking.
And this quote right here, it just hits the nail on the head. You start thinking the MACD is broken, that it's useless. But what if the problem isn't the tool itself? What if the problem is that you're using it the same way as everybody else? What if there's a smarter way, a way to filter out all that noise and see the big turning points before they even happen?
So that's the million-dollar question, isn't it? Well, it turns out the real secret, the real edge, isn't in trading those obvious crossovers everyone is watching. The real power comes from a concept called MACD divergence, and that is exactly what we are going to break down right now.
Okay, let's dive right in. So, what is MACD divergence? At its heart, it's this incredibly powerful signal that pops up when the price chart and the MACD indicator start telling you two completely different stories. It's a fundamental disagreement between price and momentum.
Think about it like this. Imagine the price as a car driving up a steep hill. The MACD indicator, that's the sound of the engine. Now, if the car is still slowly creeping higher up the hill, but the engine sound is getting quieter and starting to sputter, what does that tell you? It tells you that the upward momentum is dying out and that car is probably about to stall and roll backward. That's divergence. It's an early warning sign that a trend is running out of gas.
Now, this whole thing really breaks down into two flavors, bullish and bearish. On the left here, we've got bullish divergence. This is when the price on your chart makes a new low, but, and this is the key part, the MACD makes a higher low. You see that? That's your clue that the sellers are getting exhausted and the buyers might be ready to take over. Then on the right, we have the total opposite, bearish divergence. Price pushes up to a shiny new high, but look at the MACD. It prints a lower high. That's a huge red flag that the buyers are losing their grip and a drop could be just around the corner.
Okay, so knowing what divergence is one thing, but how do we actually turn that knowledge into a trade? How do we use it? Well, for that, we need a simple, repeatable playbook that takes us all the way from spotting the signal to actually clicking the buy or sell button.
And our playbook is just 3 simple steps. First, we spot the divergence. Second, and listen, this is the step that really separates the pros from the amateurs, we confirm the signal. We never ever act on the divergence alone. And then finally, once we get that confirmation, we execute the trade with a rock-solid plan.
So step 1 is really all about being a detective. You just draw a line connecting the lows or highs on your price chart, and then you draw another line on the corresponding points on your MACD. If those two lines are pointing in opposite directions, boom, you've spotted a potential divergence. But, and I can't stress this enough, this is not the signal to jump into a trade. Think of this as a yellow traffic light. It's not green. It just means, hey, slow down and pay very close attention.
Now for the most important step of all, confirmation. See, a divergence by itself is just a hint. Entering a trade on just that hint is basically gambling. We need to wait for the price itself to prove to us that a reversal is actually happening. And that proof can come in a few different forms, like you see here. Maybe it's a clean break of a trend line. Or maybe you see a powerful candlestick pattern like an engulfing bar. Or you could even wait for the MACD histogram to flip color. You want to see at least one of these things happen before you even think about putting your money on the line.
Okay, so once we get that crucial confirmation, then it's go time. This is step 3, and it's all about discipline. Your entry should be at the close of that confirmation candle, no jumping the gun. Your stop loss goes in a logical spot where your trade idea is clearly proven wrong, so just below the recent low for a long trade or just above the recent high for a short. And finally, you have to know where you're getting out for a profit. Aim for at least a 2-to-1 risk-reward ratio or target the next major support or resistance level. Having a plan for all 3 parts, entry, stop, and target, is completely non-negotiable.
All right, we have to have a reality check here. It's so important to talk about this because no strategy in trading works 100% of the time. And MACD divergence is definitely no exception. Understanding why it fails is just as important as understanding how it works.
The #1 danger zone for divergence trading is a market that's just going sideways, a choppy, directionless mess. In those conditions, the MACD can give you a ton of false signals that go nowhere. And you also have to remember that a really strong trend can just plow right through a divergence signal. You might see the divergence forming, but the trend just keeps on going. This is exactly why waiting for confirmation is so critical. And this quote just sums it all up, doesn't it? Divergence is not a crystal ball. It's a high probability tool, an edge,
but it is not an absolute guarantee. And that right there is why we always, and I mean always, use a protective stop loss. It's your safety net. It's what keeps you in the game when even the best-looking setup just doesn't work out.
So knowing that divergence can fail, how do we get even better? How do we increase our odds and filter out the weaker setups so we're only focusing on the A-plus opportunities? Well, this is where we can add a few pro-level filters to our playbook.
We can stack the odds in our favor with 3 really powerful filters. First up, always check a higher time frame. A bullish divergence on a 1-hour chart is so much more powerful if the daily chart is already in a nice uptrend. Second, look for confluence. Is that bearish divergence forming right at a major resistance level that you already marked on your chart? That's a beautiful A-plus setup. And third, you can use a simple moving average to give you a quick read on the overall trend. By adding these filters, we're making sure we're trading with the market's current, not trying to fight it.
All right, let's bring it all home and boil everything we've talked about down to the absolute essential rules. If you only remember one thing from this whole explainer, make it what's on this next slide. So here it is, plain and simple. The do's, you do wait for that confirmation signal. You do use a protective stop loss on every single trade. And you do have a clear exit plan before you enter. And the don'ts. You don't enter on the divergence signal alone. You don't ignore the overall market trend. And you don't try to force trades when the market is choppy and messy. Stick to these rules and you will already be way ahead of the crowd.
So there you have it. That's the complete playbook for trading MACD divergence. A seriously powerful tool if you use it the right way. But now I really want to hear from you. Have you ever traded with MACD divergence? What kind of results have you had? Share your experiences, good or bad, down in the comments section. Thanks for tuning in.